Hi guys, I hope you hear me well and see my video. I just wonder about why we are less people today. How many people? Let me see, 10 people including me. Do you have any exams or quizzes today or the day after today? Maybe they are preparing for them. Which exam, Nergis? By the way, how was your midterm? Çağatay Müəllim, last time I talked to him. He had checked 2 sections out of 4. Your total average is for these 2 sections 72, including 55 for multiple and 17 for open-ended ones. It's from my second career track. What's your second career track? Economics, IT, really good. So whenever I have in the future a problem related to IT, I will contact you, Nergis. IT is general. Which specific field you mean? User experience, backend designing, backend development, user interface designing. Okay, I got it. Anyways, today we will focus on multiple choice questions part of the midterm, as Çağatay Müəllim said in the class, because he explained some of them in the given time, 75 minutes, but there were the questions that left unanswered. Therefore, we will start answering them. But if you want, if you wish, we can start from the first question. No matter Çağatay Müəllim explained it or not. If you need it again to be explained, we can start from the first question. Okay, let me share the screen. From the first one, okay. Tak. Okay, I hope you see the questions. Baku Stock Exchange buy side and sell side orders are as follows for security. Quantity buy, price sell, quantity sell. You see the numbers here. Actually, quantity part, we don't know. We don't have anything to do with quantity part. What we are concerning about here, it is the price. In which price we are buying the security. We have 2 types of price: buy price, it is bid price, and sell price, ask price. So we know that we choose highest price in the buy orders and lowest price in the sell orders. Because if I am selling my stocks, if I want to sell my stocks, and if there are several buyers that want to buy my stock, who offer higher price, then I will sell to him and he will buy my stocks because he has highest price, offered highest price. Therefore, I choose highest price, as well as from the sellers. For example, I want to buy a stock from number of investors. So I see that one of them is selling for 10.2, 10.2, 10.25, 10.3, 10.5. It is the lowest price for me that I can buy that price. Therefore, the highest price from the buy side, which is 10.10, and lowest price from the sell side, which is 10.20. So therefore, our answer is C, best buying price and best. I'm sorry, answer is D, 10.10 and 10.20. The answer is D. Is it clear? Sorry for interruption. Do you know when Çağatay Mellim will hold oral exams? During multiple choice part, I had some problems and I was kicked out from the test. Çağatay said me that he will take oral exams from me. Next, probably after he finished all the sections, he finished checking all the sections papers because he has checked 2 of them. If he finishes grading all of them, then he will conduct oral examination. You are welcome. So first one is D. Second one, in the one period valuation model, if a stock's value falls, if the rises. What rises if the stock's value falls? Let's look at what we are given. Dividend. According to Gordon-Gross model, we know that the price of the stock is the present value of future cash flows or present value of future dividends. Basically, to simply put, the price of the stock, current price of the stock, is equal to next year dividend, D1, divided by R minus G. R is required rate of return, and G is gross rate. So dividend is in the numerator, and R minus G is in the denominator. So if the numerator increases, it means the value will increase. Or if the denominator increases, it means value will decrease. So dividend is in the numerator. And if dividend rise, the stock price should rise, not fall. Therefore, A is not correct answer. Expected future price. For example, future price in 5 years, P5. So if P5 increases, we discount this P5 to the year 0, and the discounted value of P5 will also be increased. Therefore, it is not the falling that the reason that stock value falls. B is also not correct. Required return on equity, required rate of return. It is in the denominator. And if the required rate of return increases, the difference R minus G will increase. So the denominator will increase and stock value will decrease at the same time. Current price, it is also stock value. If current price rise, it means stock value rise. So therefore, answer is C, required rate of return on equity. Is it clear? Great. Let's continue. Holding other things constant, a stock's value will be highest if the most recent dividend is. So we know that in order to find the price, stock value, stock price, we divide dividend. So the dividend should be as much as possible highest one in order to make the stock value also highest. So therefore, we choose the most highest dividend here, $5. So $5 dividend will increase the stock value, highest, will lead to highest stock value. I think it's also clear. Great. A weakness of the PE approach, PE is price to earnings ratio. Guys, by the way, some students confuses earnings with dividends, but dividend is not earnings. Maybe company can't pay or don't pay dividend. It depends on dividend policy of the company. We'll cover it corporate finance course. Company might be don't pay the dividends, but it has earnings per share. Earnings is earnings per share. It means the net income or net profit minus preferred dividends, because we should subtract preferred dividends, preferred stocks dividends. Simply net profit divided by number of outstanding common shares. So we find earnings per one share. This is not dividend, actually. So PE approach to valuing stock is that it is difficult to estimate constant growth rate of firms' dividends. We actually don't estimate constant growth rate of dividends with PE approach. So our answer is not A. Difficult to estimate required return on equity. It's not the deal. Also, we don't estimate required return. Difficult to predict how much a firm will pay in dividends. It is also depends on the financial performance and condition of the company. If financial condition allows firm to pay dividend, then company will pay dividends. And again I say, it depends on the corporate dividend policy. And D1, based on industry averages rather than firm-specific factors. So PE approach generally takes industry average, not taking into consideration all firm-specific factors. For example, I'm saying from myself, for automobile industry, the price to earnings ratio is 15, approximately 15 for this industry. So it means the participants in that industry, in automobile industry, for example, Mercedes, Toyota, BMW, and etc., they have up and down equals somehow closer PE ratio to 15, and if their earnings is paid to the investors, is revealed, so we can simply multiply these earnings to PE ratio in order to estimate the price. But it's not the true one, because each company can its own dividends, can its own growth rate, can its own risks, other factors. But PE ratio don't take into consideration deep details. So therefore, it is the weakness of PE approach, and D is correct one, based on industry averages rather than firm-specific factors. Is it clear? Okay. ABC company pays annual dividend of 1.31 AZN and plans on increasing that amount by 2.5% each year. XYZ company pays an annual dividend of 1.28 yen and plans on increasing its dividend by 3% annually. Given this information, Nijar, a principles of finance student at AD University, knows for certain that stock of XYZ company has higher than the stock of ABC company. Total return. In order to know total return, we should know first to calculate capital gains return and dividend return. For the capital gains, I mean for the dividend yield, we should know the price of the bond because we divide dividend to the price in order to define dividend yield. So therefore, total return is impossible to know with this information. Dividend yield, also we don't know again the price of the shares of these companies, so therefore we cannot calculate dividend yield. Capital gains yield. The true answer is capital gains yield. Why? Actually, capital gains yield is gross rate for the company. So what is capital gains yield? Let me stop the sharing. So capital gains yield is equal to P1 minus P0 over P0 multiplied by 100%. I hope you see that. Capital gains yield P1 minus P0 over P0, and you can also multiply it by 100%. We know that P0 is equal to P1 D1 divided by R minus G. P0 is equal to D1 divided by R minus G, and P1 is equal to D2 divided by R minus G. So we can substitute P1 with D2 over R minus G. No, R is not that part of our calculation. I will show you. Just be patient. D1 over R minus G. So in this equation, I substitute P1 with D2 over R minus G and P0 with D1 over R minus G. And plug in their positions, places. So D2 divided by R minus G minus D1 divided by R minus G over D1 divided by R minus G. We can R minus G D1 D2 over D1. We can combine this in common denominator because they have the same denominator. We can write like that: D2 minus D1 over R minus G over D1 over R minus G. Denominators are the same. We can easily cancel out them. You see? So what we left with D2 over D1, D2 minus D1 over D1. D2 minus D1 over D1 from there to there. And D2 over D1 minus 1. From the equation, it is D2 over D1 minus 1. What is D2 over D1? We know that D2 is equal to D1 plus D1 multiplied by 1 plus G. D2 is equal to D1 multiplied by 1 plus G. So we substitute D2 with D1 multiplied by 1 plus G over D1 minus 1 here. You see? And we can cancel out D1s here in denominator and numerator. So what we left with 1 plus G minus 1, it is G. Yes, G is left only. So from there to there, we come across that our capital gains yield is equal to actually gross rate, G. Is it clear? Nergis, is it clear? You saw that we didn't use any R. Okay. Sure. Let me share the screen and let's continue. The dividend growth model assumes that dividend increase at a constant rate forever. So that's the basic assumptions of dividend growth model. Can be used to compute a stock price at any point of time. So you can calculate P0, P1, P2, P3 with the following dividends. Can be used to value zero growth stocks. So in the formula D1 over R minus G, if G is 0, so it is D1 over R. It is also assumption of dividend growth model and requires growth rate to be less than required rate of return. Definitely, because it is R minus G. If G is greater than R, so the difference will be negative and we cannot calculate divide dividend to negative number. So therefore, growth rate should always less than required rate of return. Therefore, all of them, 1, 2, 3, and 4 are correct. For our question, the answer is D. Any questions? Great. Which one of the following transaction occurs in primary market? Okay. Primary market. Purchase of 500 shares of GE stock from a current shareholder. If I am purchasing GE stock from a current shareholder, so it means current shareholder has also purchased the stocks from somewhere else, or maybe in primary market, and he became shareholder. And now he is selling his shares to me. But where should be the location, exact location, in order to make the transaction happen? Of course, in secondary market, because primary market is the for issuing new stocks and bonds, new securities, and first investors who buys from the company directly, it is in the primary market. But I am purchasing GE stock from the current shareholder, So it means it is secondary market because current shareholder came to secondary market and trade with other investors. So A is not correct. IBM's purchase of GE stock, it is also a secondary market issue. I mean secondary market transaction. Gift of 200 shares of stock by mother to her daughter. It is also secondary market deal. And a purchase of newly issued stock from AT&T. Newly issued, we see the newly issued stock. So it is primary market transaction. Is it clear? Okay. Company ABC paid an annual dividend of 1.15 AZM per share. Today, the company announced future dividends will be increasing by 2.6% annually. If you require 12% rate of return, how much you are willing to pay purchase of one share of this stock today? Let me open Excel file. For our question. Okay. What is the number of question? Question 8. Has paid annual dividend of 1.15 AZM per share. It is already paid, so it is D0. 1.15 AZN. The company announced future dividends will be increasing by 2.6% annually. So our G is 2.6%. Okay. If you require a 12% rate of return, R is 12%. What is our P1? Actually, how much are you willing to pay? It is also actually P0. We know that P0 equal to D1 over R minus G, or D0 multiplied by 1 plus G over R minus G. So in our case, D1 is not directly given, so we should find D1 with D0 multiplied by 1 plus G. So D0 multiplied by 1 plus G divided by R minus G. Why it shows error? P2 I forgot multiplication sign. Okay. So everything is incorrect. Yes, I forgot the multiplication sign here. 12.55 AZN. So it is our P0. Question 8. The answer is B. 12.55 AZN. So it is clear. Yes. Okay. If the expected return on the stock is 9.4%, assuming RF is that much, RM is that much, what must be the beta? From the CAPM formula, we know that CAPM, expected return, RE, let me write it like that, RE is equal to RF plus RM minus RF, risk market return minus risk-free rate, multiplied by beta. So in our case, we have RE 9.4%, RF and RM, United Nations, RF 2%, RM, it is RM actually, and RF 5.2%. Beta is equal to expected return from the security minus risk-free rate over risk premium. The answer is A, 0.7. Is it clear? Okay. When Ali, who is a student of Principles of Finance at the university, makes a comparison between preferred stock and common stock, he determines that common stock provides higher average return. That's true answer, because common stock has high volatility and high risks. Therefore, high risk is equal to high return in itself. A is correct answer. Let's look at other answers. Common stock prices are less volatile. It is not true, because common stock prices is determined by market demand. So market demand cannot decrease and increase for that stock. Also, it is depends on the economy, condition of the economy, financial performance of the company. Therefore, common stock prices can easily fluctuate and therefore can be volatile. Volatility, guys, it is the stock price moves like that, very large fluctuations. So if it's increasing almost constant, it means less volatile, but higher volatile is shaking like that. Preferred stock pays more frequent dividends. More frequent, it is not correct answer, because preferred stock pays fixed dividends, not frequent. There aren't any difference between common stock preferred. It's also not correct. Therefore, 10 is A. The correct answer is A. Any questions? Guys, do you hear me? Do you see the screen? Do you see my video? Because my internet connection was interrupted. Anyways, I hope you see me. I can continue. Adalet, a principles of finance student at the university, knows that any securities that can be sold back to the issuing company at a predetermined price as known. So if security allows you to sell back, if you want, at a predetermined price to the company, it is putable stock. Callable stock means the issuer side or company can take back the stock from you or repurchase the stock from you. But in putable case, you can sell back to the issuing company. The answer is B. By the way, guys, on your midterm, the true answer for this question mistakenly noted as A, callable stock. So therefore, that question is considered wrong answer in most of your answer sheet. Therefore, a couple of days ago, Çağatay Müəllim corrected his mistake. Some of your grade increased by 2%. Yes, that was this question. The answer mistakenly noted as A, but the true answer is B. Okay, Elvin, a principles of finance student at AD University, knows that main reason for firm to issue equity is increase the publicity for the firm's product. It is not the marketing purpose. Acquire the necessary funds for its operations. That's the correct answer, and that's the main reason of firms issuing equity. Generally, firm has two types of financing. Debt financing and equity financing. So when they need finance, why they need finance? Because they have operations. In order to finance and continue their operations, they need finance, and they need finance. They have finance from debt sources and equity sources. They can go to the bank, take loan, or issue bonds. That's debt part. But firm can issue also his shares. Its shares, it is equity source of capital. So main reason for a firm to issue equity is acquire necessary funds for its operations. That's easy question. Switch to certain question. Fidan, principles of finance student at AD University, learned that has the most risk from the investor's perspective. Callable common share, callable preferred share, putable common share, putable preferred share. From the first glance, callable securities are more riskier than putable securities from the investor perspective, because putable securities allows investor to sell back to the issuing company when they want, but callable securities allows company to repurchase their securities from the investors. So the company, if it is callable common share, if the company see that the share prices are low, so company can repurchase its shares at the lowest price from the investors. It works for the interest of company because company repurchase at the lowest price, but it is worse from it is very bad from investors profits, because they sell at the lowest price. They gain lowest price from the company in terms of callable common share. Preferred share, they have fixed dividends. They have somewhat fixed prices. Therefore, common share more volatile and more riskier than preferred share, and also in callable case, callable common share is more riskier than callable preferred share. Answer is A. Is the question is clear? Okay, security exchange market where investors buy and sell long-term corporate and government bonds from investors is described as a part of money market. Money market is where short-term debt instruments are traded, not long-term. Therefore, it's not correct answer. Primary market. In primary market, newly issued stocks are traded. I mean, company go IPO and issue new stocks to the investors. It is not buying and selling of securities. So primary market is not part of it. Capital market. Of course, the answer is capital market, because in the capital market we trade long-term capitals, both corporate bonds, government bonds, and also stocks in the capital market. Therefore, the answer is C. Emerging market is different scenario. It is clear, I guess. 15th question. Junai, a principles of finance student at AD University, knows that an order to sell security at best price available is a buy market order, sell market order, buy limit order, and sell limit order. From the first put, and if it is an order to sell security, order to sell the security, not buy, so we should exclude the answer with selling. I mean with buying orders. So we are looking for sell order, not buy orders, because we want to sell our security. So we have left with two options, sell market order and sell limit order. If we are looking for the best price available for our security, it is market order, not limit order, because in limit order we are entering market with our limits. For example, I want to sell my stock at minimum, at least, for example, $10.2, 10.2 and more than that. That's limit order. But at the best price available, when you enter your order, the broker or dealer will be looking at the possible prices, current prices at the market, bid prices. So who bid the highest price, that would be your order, the winner of the order. So your security will be sold to him. Therefore, the answer is sell market order. Is it clear? Great. 16. Ibrahim, a principles of finance student at AD University, bought a stock at price of 10 ASEAN last year. He received 0.5 ASEAN as a dividend, and then he sold the stock at price of 13 ASEAN. 13 ASEAN. What is his return on this investment? His return means total return, both summation of both capital gains yield and dividend yield. Let's calculate. Question, what's the number? Question 16. A stock at the price of 10 ASEAN last year. So let's take last year price as P0. Last year. It is 10 ASEAN. Received dividend 0.5 ASEAN as dividend. So it is, if he bought stock last year, it means he will receive this year dividend. D1 this year. Let's say D1 0.5 ASEAN. Okay. Then he sold the stock at price of 13 ASEAN. It is all P1 this year. 13 ASEAN. Okay. What the question is asking is total return. Total return is equal to capital gains yield plus dividend yield. Dividend yield, capital gains yield is equal to, we know that P1 minus P0 over P0. So capital gains yield is equal to P1 minus P0 over P0, 0.3. Dividend yield, let me delete this cell. This is also unnecessary. Okay. Dividend yield is equal to D1 over price. So in our case, D1 0.5 divided by P0, 10 ASEAN, 0.05. So total return on this investment is equal to 0.3 plus 0.05. In percentage terms, 35%. The answer is B. Is it clear? Okay. Okay. Question 17. For the company ABC, expected dividend growth rate in G decrease from 7 to 0. Also assume that required return for that company will maintain their historic levels. The firm's stock price will. So if the growth rate decrease from 7% to 0, it means R minus G difference will increase. And R minus G difference is in the denominator of the ratio. So if the denominator will increase, it means the price, stock price, will decrease. Therefore, the answer is B. Stock price will decrease if the growth rate decreases. Gotcha, I can share Excel file after session, but not questions. Because questions, if I share the questions, I violate the confidentiality. But I can share the Excel files. Yes. Actually, it is recording the session. I'm recording the session. You can also watch the questions from the video or take a screenshot, whatever you do. But some of you requested also this question with also answers. I cannot even send you the questions, also answers. Okay. So it is number 17. Number 18. The company pays dividend 7.5% fixed dividend for 100 ASIN par value preferred stock. The preferred stock dividend is 6%. What's the value of preferred stock for this company? So, question 18. Par value of preferred stock is 100 ASIN. Fixed dividend percentage terms, in percentage terms, it is 7.5%. So it means preferred stock dividend is equal to 100 ASIN multiplied by fixed dividend percentage, 7.50 ASIN. Also, stock dividend yield, we know that dividend yield is equal to D1 over P0 is 6%. The question is asking what's the value of preferred stock. Value of stock is equal to, so if stock dividend is 6%, preferred stock dividend is 7.5%, we can divide dividend over 6%. 125 ASIN. That's the value of preferred stock. Is it clear? Any questions? Okay. Johan, a principal of finance student at Ede University, wants to invest to a company's preferred stock with a required rate of return 15%. The company's preferred stock pays dividend amount of 10 ASIN, fixed dividend amount. What's the price, maximum price that she would pay? So required return, question 19, required rate of return is equal to 15%, fixed dividend 10 ASIN. So what's the maximum price she would pay? Maximum price is, if we don't have gross rate, so it means dividend over R. Dividend over 15%. 66.67 ASIN maximum price for this stock. I hope it's also clear. The answer is C. Alice says, I would like to know if I can see on which questions I have made mistakes in math. Is that possible? Ask from Çağatay Melim. Probably he has an access to questions. I don't have access to them, unfortunately. Great. Question 20. Preferred stock has a fixed dividend and maturity. That's not correct answer because stock doesn't have any maturity. It represents ownership in the company for an infinite period of time or till when the company collapses. Therefore, stock has no maturity. Fixed dividend and no maturity. That's our correct answer. Variable dividends are for common stocks, not preferred stocks. The answer is B, fixed dividend and no maturity. Common stock has also variable dividend, no maturity. We said just here. Variable dividend, no maturity. Question 22. What's the value of preferred stock that pays annual dividend of 10 ASEAN if yield on this company preferred stock is 100 basis point above the current government bond rate? So, annual dividend of 10 ASEAN, the value of stock, preferred stock. The question 22. Annual dividend Tunisian. Okay. Current government bond yield 4%. Spread of 100 basis points 1%. So it means dividend yield is equal to 4% plus 1% is equal to 5%, because in the question it says yield on this company's preferred stock is 1% above the current government bond rate. So we have dividend yield, not dividend yield. Yes, it's dividend yield. It is dividend yield. I'm sorry, it's dividend yield. So value of preferred stock is equal to 10%, 10 manat, 10 ASEAN over 5%. 200 ASEAN. Is it clear? Okay. Analysts gathered following information for a company. An estimated growth rate for the next 2 years is 20%. The company will have a constant growth rate of 4%. Required rate of return on this for this company is 10%. Dividend in the year 1 is estimated 1 ASEAN. So if the stock traded at the price of 15%, we can conclude that the stock is undervalued by. Undervalue means if the stock's intrinsic market value is less than its intrinsic value, it means stock is undervalued in the market. Or otherwise, if the market price is greater than intrinsic value, it means the stock is overvalued in the market. So we have, what's the question number? Question 23. Let's take, we have I want to draw the timeline. Let me draw the border. Year 0, year 1, year 2, year 3, and 4. And 4. That's the illustration of timeline on Excel. Year 0, 1, 2, 3, and 4. So in year 1, we have D0 also, D1, D2, D3, and D4. So estimated growth rate for the next 2 years is 20%. So growth rate for 2 years is 20%. And after that, we have constant growth rate of 4%. Let me merge it, and 4%. Okay, so for 2 years, it is 20% growth rate. It is our G, by the way. It is our G, growth rate. And it will grow 4% constant at 4% rate thereafter. Okay, anyways. So then what we have, the required rate of return for this company is 14%, no, 10%. Our required rate, it is same for all periods. %, for all periods. 10%. Dividend in the year 1 estimated in the year 1 estimated 1 ASEAN. So D1, our D1 is 1 ASEAN. 1 ASEAN. If stock traded at price of 15%, market price 8% there, 15 ASEAN, we can conclude that stock is undervalued or overvalued. So we have D1. We can calculate then D2, D3. D2 is equal to D1 multiplied by 1 plus 20% rate, because we are currently working with 20% because we are in year 2. Year 2's dividend 1.20 ASEAN, and D3 is equal to D2 in this case multiplied by 1 plus this rate, because starting from year 2, rate will be 4%. Okay, or let's do like that. If we know D2, D3, we can easily find P0 here, P2 here. P2, we know that P2 is equal to D3 over R minus G. So P2 is equal to D3 divided by R minus 4%. Why 4%? Because we are discounting it from here. We are discounting these cash flows with 4% gross rate. 20.8 ASEAN. This is our P2, right? Then we should discount D1, D2, and P2 in order to find the price of the security. I mean, P0 is equal to discount of D1, D2, and P2. So let's discount one by one. Present value of, let's say, D1 is equal to 1 ASEAN divided by 1 plus required rate. Present value of D2 is equal to 1.2 divided by 1 plus required rate to the power of 2, and as well as present value of P2 is equal to this one divided by, again, required rate to the power of 2. When we sum up them, we calculated all the given inputs. P0, or value of stock, is equal to summation of D1, D2, and P2. 19.09. So this is value of the stock. intrinsic value of the stock. Let me write like that, intrinsic value. Value of the stock. Intrinsic value. So intrinsic value, market price, but current market price of this stock 15.15 ASEAN. So undervalue difference is 19 minus 15, 4.09 ASEAN. The difference between intrinsic value of stock and market price. Is it clear? Okay, great. The analyst gathered the following information for the company. Again, question 23, question 24. Demelim. Let me copy down all the things here. So this is our timeline. Okay. Our growth rate. But in this case, we have only one growth rate, 5%. Therefore, let me merge them again. Okay, 5%. And 10% required return dividend in year one. Estimated 1 ASEAN, again, D1 is 1 ASEAN. Okay. If stock is currently traded at 7.25% ASEAN, current market price 25 ASEAN. So let's find the intrinsic value. We know that P0 is equal to D1 over R minus 3. So from that respect, P0 is equal to D1 over R minus 3. So current market price is 25 ASEAN, but intrinsic value, it is also intrinsic value, is 20 ASEAN. It means undervalue, in this case, overvalue difference. Because market price is higher than fair value, intrinsic value of this security. 25 minus 20 ASEAN. 5 ASEAN overvalue difference. The answer is A. Is it clear also? Great. 25. Jamaluddin, a principal of finance student at ADA University, gathered the following information for his homework. Risk-free rate, expected return on the market. Let me write down here. Question 25. Risk-free rate 5%. expected return on market %, beta of ABC company is 1.5. Last dividend payment amount. Last dividend payment amount, which is D0, is equal to 2 ACM. Expected growth rate which is forever 5%, if I'm not mistaken. Yes. Under this information, the value of the stock is okay. In order to value of the stock, P0, again, we know that is equal to D1 over R minus G. This R is expected return of this security, required return of this security, but it is not given in the question. Therefore, using KPM formula, we have to find our KPM return is equal to risk-free rate RF plus RM, you know, minus RF multiplied by beta. So our required rate of return is equal to risk-free rate plus brackets market rate, market return minus again risk-free rate multiplied by 1.5. 15.5%. So we have required rate of return, we have gross rate. Also, let's find also dividend. Next year dividend. Year's dividend, which is D1, is equal to D0. Where is D0? Here. Multiplied by 1 plus G, expected gross rate, 2.18. So value of the stock is referring this formula is equal to next year dividend D1 over required rate of return minus gross rate. Value of stock is 20 ACM. The answer is C. 25 is C. Do you have any questions? Okay, guys, if you don't have any questions, I think let's take a break because we have 15 questions left from the multiple choice part. Let's take a break, 15 minutes break, and after 15 minutes break, come back here. In 1920. Yes, in 1920, be here. So be here at Okay, guys, I hope you are here. Let's make sure. Great. Let's continue with 26th question. Ceteris paribus, it means all else equal. If there is an increase in the required rate of return, the stock value will under the constant dividend growth model. So everything, keeping everything else equal, ceteris paribus, we know that required rate of return is in the denominator. Okay. I'm sorry. Okay. Do you see now? Great. Ceteris paribus, if there is an increase in the required rate of return, stock value will under the constant dividend growth model. Ceteris paribus means all else equal. So we know that required rate of return is in the denominator of the dividend growth model. So if the required rate of return increases, it means the denominator increases, and as a result, it will lead to the decline of the stock value. So stock value will decrease in this case. The answer is B. It is clear, I think. So ceteris paribus, if there is an increase in constant growth rate, stock value will under. It is obvious that it will increase because growth rate is in the numerator on the ratio. So numerator increases, it means the value will be increased. The answer is A. 28. Laman, principles of finance student at ADA University, gathered the following information. Preferred stock dividend payment 5 ASIN, firm's conferred bonds yield 6.25%. Let's write it here. Question 28. Let's make it bold. Firm's preferred stock dividend payment 5 ASIN. Corporate bond yield 6.25%. Then we have, let me copy it from here, 75 of basis points, 0.75%. So it means dividend yield, preferred stock dividend yield is equal to corporate bond yield plus 0.075. 7%, roughly 7%. So price of preferred stock in this case is equal to stock payment divided by yield. I think I got wrong. Wait. Below bond yield. I just summed them. I thought it's above bond yield. Minus. In this case, answer is true. I confused. I thought it is above the bond yield. It should be below the bond yield. So the answer is 9.91 B. Is it clear? Okay, Shuhayla. Great. 29. Mohammed, the principles of finance student at AD University, estimate the intrinsic value of stock 25 ACM per share. If the market value of this stock is trading at the price of 30 ACM, the market is, so intrinsic value means the fair value, true value of the share is 25 ACM, but current market price is 30 ACM. It means market overvalued the stock. So therefore, the answer is market is overvalued the stock. Market overvalued the stock, not is overvalued. It's the grammar mistake. Market overvalued the stock. Answer is B. I hope it's clear. Which of the following statement is wrong about dividend discount model? Cannot be applied when G is bigger than required return. That's true, because if G is bigger than required return, it means the denominator R minus G difference will be negative numbers, so it is impossible to divide to negative number. Is inappropriate for the firms with variable dividend growth. It is also true because, for example, assume that a company has different growth rates for each year. For year one, 6%, then 7%, 8%, 5%, 4%. And when we calculate it, we cannot calculate with different growth rates with dividend discount model, because dividend discount model assumes constant growth rate, one constant growth rate, not variable, and is best for rapid growing firms, not rapid constant growing firms. Dividend discount model. So the answer is, so what is wrong? Wrong statement is third one. The answer is A, because it is first one is true, second one is also true, third one is wrong. Is it clear? Okay. Ceteris paribus, if there is an increase in beta of the stock price will. So we know that according to CAPM formula, required rate of return is equal to risk-free rate plus risk premium multiplied by beta. If we increase beta, then required rate of return will also increase, as well as required rate of return is in the denominator of the dividend discount model. So dividend denominator will increase. It will lead to decline of the stock price. Therefore, stock price will decrease if an increase in beta of the stock. There is an increase in beta of the stock. The answer is B. It is also clear, I hope. Astor company has just paid 1 ASIN dividend per share. Dividends are expected to grow at 7% forever. Calculate the value of stock with 11%. That's very easy question. So question 32 should be just paid dividend amount it means D0, 1 ASEAN. Constant growth rate, G is 7% forever. Calculate value of stock with 11% required return. %. So we know that P0 is equal to D1 over R minus G. So if we don't have D1, we can calculate it with, substitute with D0 over 1 plus G over R minus G. So in this case, D0 multiplied by 1 plus G divided by R minus G. 26.75 ASEAN. What I did wrong here? Okay. Guys, be careful in this question. Çağatay Mellim mistakenly calculated, referred 1 ASEAN as D1, not D0. The true answer should be this one. The true answer should be this one. But he treated 1 ASEAN as next year's dividend, D1, by mistakenly. Therefore, selected answer 25%. So if it D1 mistakenly, let me write here. If you treat D1 1 ASEAN, then it means the P0 mistakenly in question will be D1 over R minus G, which will be 25%, yes. Çağatay Mellim said this to me to consider in the TA session. Now I remembered. Okay, yes, right.
I'm sorry, Cameron, can I ask a question?
Yes, sure.
For example, if I choose some other answer, not 25, so still I will not get any point for this question, right? Even though there was a mistake in the question. I should have choose 25, right?
Yes.
Okay, thank you very much.
You're welcome. So it is clear. Let's switch to question 33. Nergiz, a principal of finance student at AD University, gathered following information about Azertürk company risk-free rate RF 5%, market premium RM minus RF should be 10. It's also 5%. Beta of Azertürk company 1.5. Last dividend, it is D0, 1 ASEAN, Next year dividend will be 10% higher, so which means gross rate G 10%. Next year price will be 25%, 25 AZN. Next year price 25 AZN. Guys, we know that P0 is equal to discount of D1 and P1. Next year dividend and next year price P1. So let's divide. First we found D1 next year dividend D1 is equal to last dividend D0 multiplied by 1 plus gross rate 1.10 1.10 and next year's price it is this amount of money. So we should discount by required rate of return, but we don't know required rate of return, so we should find rate of return. We should find it by KPM formula using risk-free rate plus market premium multiplied by 1.5%. So present value of D1 is equal to next year's dividend divided by 1 plus required rate of return, and present value of D1. Let me write here present value in order not to be confused. P1 is equal to next year price. Let me write here P1 divided by 1 plus required rate of return. So P0 value of stock P0 is equal to this much plus this much. 23.20 AZN. The answer is A. Is it clear? Great. 34. Nermin, a principles of finance student at AD University, is expecting an abnormal growth period for QWERTY company, has also gathered following information. Last dividend. Question. $34. So last dividend D0 is equal to 0.25 AZN. Next year expected growth. Next year expected growth, which is, let's denote at G1, is 20%, 25%. Second year expected growth expected growth, which is G2, negative 5%, which is minus 5%. And starting from third year, think from third year, constant growth, which is G3, will be 8%. And investors require required return RS, which is RS 12%. What is the value of this stock? Let me draw the timeline. Copy it from here. D1, D0, D1, D2, D3, D4. So we have growth rate G. Okay. For the first year, G1 will be 25%. For second year, next year, second year, G2 will be minus 5%. Let me change the color of it. And starting from G3, G2, and forever, G3, it will have constant growth of 8%. Let me change its color also. Let's take gray. Okay. And required rate of return is the same for all the years, 12%. What we are required to value the stock? To value the stock, we know that we should find D1, D2, D3, and D4. D1 is equal to D0 multiplied by 1 plus growth rate. D2 is equal to D1 multiplied by 1 plus this growth rate. D3 is equal to D2 multiplied by this growth rate, new, and it's also is the same growth rate, D4. So if we have calculated D4, we can easily calculate P3, because P3 is equal to D4 divided by R minus G3. D4 divided by R required rate of return minus G3. It is our P3. So the present value P0 of the stock is present value of D1, D2, D3 and P3. Let me write PV of also. So PV of D1, PV of D2, PV of D3, and PV of P3. D1 divided by 1 plus required rate. D2 divided by 1 plus required rate of return to the power of 2. D3 divided by 1 plus required rate to the power of 3. And P3, present value of P3 is equal to P3 divided by 1 plus required rate to the power of 3. And in this case, value of stock is equal to summation of all this. Summation of D1, D2, D3, and P3. The answer is A, 20.79. Is it clear? Great, great. 35. In the one period valuation model, a stock value falls if the stock value falls if dividend rises. It's not correct because dividend is in the numerator of dividend discount model. If numerator increases, it means the stock value will increase. Expected future price. As I said before, for example, expect future price in 5 years, P5. If P5 increases, it means the discount of P5 to the year 0 will also increase. Therefore, it's not also true. Required return on equity, that's the correct answer because it is in the denominator. I think if denominator increases, the answer will decrease. 35 is C. 36. In the generalized dividend valuation model, stock's value depends only on dividend valuation model includes dividend and rate, required return. Its future dividend payments and future price. Its future price is also valued by dividend payments, so it is not the factor. Its future dividend payments and the required return on equity, that's correct answer because we are valuing the dividend stocks with its future dividend payments and required return. It's future price, not future price, and future dividend payments. It's incomplete answer. The answer is B. Future dividend payments and return on equity. Ceteris paribus, a stock value will be highest if investors' required return on investment 20%, 15, 10, 5%. Answer is clear. It is 5% because the less required return will be, the highest stock value will be. Because required return is in the denominator. So if we decrease the required return, then the denominator will decrease. It means the stock price will increase. Therefore, among them, 5% required return will lead to highest stock value. I hope it's also clear. Stock values computed by valuation models may differ from actual market prices because it is difficult to estimate future dividend growth rates. That's correct, because in the reality we cannot assume, we cannot know exactly what the future dividend growth rate will be. In the calculations, for the sake of simplicity, we take constant growth rate and apply it for all dividends. Estimate risk of stock. Also, we cannot know what the risk level will have, the stock will have. Forecast a stock's future dividends. It depends on the firm's financial performance. Firm can decrease the dividend payment, increase dividend payment, or keep it constant, or eliminate it sharply. So all of above are true. All answers are true for this question. So the answer is D. Any question? All of them are correct. Okay. A share of common stock in the firm represents an ownership interest in that firm and allows stockholder to vote, receive dividends, and receive interest from it. Guys, vote means common stockholders have right to vote to elect the members of boards of directors. İdare heyəti deyirlər Azərbaycanca. İdare heyəti, corporate governance, boards of directors. Amma boards of director memberləri stockholderlar, shareholderlar, səhmdarlar tərəfindən seçilir. Səs verməklə. The members of boards of directors are elected by vote of shareholders, common shareholders, not preferred shareholders. Preferred shares has no right to vote. Therefore, common stock share in a firm represents allows owner to vote, to receive dividend, and that's it. Not interest payment, because it is not bond. Bond receive payments, bondholder receive payment, interest payment. So first one is and second one. First and second is true. The answer is D. 39. And fourth question. When a bond's present value is above its par value, the bond is selling at a premium, because if bond's price is above its par value, for example, bond's price is 110, but par value is 100, it means bond, it is premium bond. So premium, we exclude C and D. This occurs because bond's coupon rate is above the market rate. If coupon rate is higher than yield to maturity, it will be coupon premium bond, otherwise discount bond. Therefore, premium and above is correct. We have also quiz 2 questions, because if I'm not mistaken, Çağatay Müəllim used quiz 2 multiple questions in the midterm. So if you want, we can discuss them. They are 20 questions. If you want, we can discuss them. Okay. Your target is to earn annualized rate of 5%. What is most you can pay for a 131-day treasury bill that pays 10,000 AZN at maturity? Assume 1 year is 360 days. So question 41. we know that annualized yield is equal to future price minus present divided by present multiplied by $360 in our case over number of actual days. We know that formula. So our target is earned to annualized yield 5%. Number of days. Treasury. What's treasury bill? T-bill. Treasury bill maturity. Days. 135 days. And future price at maturity is 10,000 ASEAN. Price of T-bill, treasury bill is equal to 10,000 divided by 1 plus annualized yield multiplied by 360 over 135 number of days. It's not correct. What I did it here wrong. I'm sorry. I just confused the places. Over it's that much. Yes, that should be the correct answer. Why? Çünkü annualized yield, if it is our annualized yield for 5% is our annual yield for 360 days. But we need the portion for 135 days. 135 gün üçün bizə lazımdır. Ona görə 360-da 135-ə vurmalıyıq biz annualized yield-ı. We have to multiply annualized yield by 135 over 360. Therefore, our price of treasury bill should be 9,860 ASEAN. 16 ASEAN. Okay, thank you. You're welcome. We have left with only Radha. Others will watch from the recording. Question 42. 42. Approximate annualized yield on treasury bill. It is also referring to the same formula. We know that purchase price is Asian face value 5,000 Asian will mature in maturity in days 270 days. So our annualized yield is equal to face value minus purchase price divided by purchase price over 360 divided by 270. Forty-two is A. I hope it's clear. Is it clear, Rada? $43. Which one of the approximate periodic interest rate on treasury bill that you purchase for that Asian that will mature? We did it actually. This is asking for periodic interest rate, not annualized rate. Okay. Periodic interest rate is equal to future price minus present purchase price over, in this case, future multiplied by over days. Purchase price is the same as in the previous question. Okay. Periodic interest rate. Periodic interest rate 5,000 minus this amount over 5,000 in this case multiplied by 360 divided 270. What is incorrect answer? Which one is the approximate interest rate? Approximate interest rate. What is incorrect? Where I did mistake. I think there is I think there is a mistake in the question itself, not my solution. Let me delete it for the anyways. Because all is the same. There is there is a mistake, I think. Not other way out. I think there is a mistake in this question because the given inputs are the same. Approximate periodic interest, approximate annualized yield is also the same. In any case, I will contact the Çağatay Meryem. Okay. Qwerty company issued a bond with face value of 100 ACN. If the market price is 985 ACN and annualized interest rate is 4%, when will this bond mature? When will this bond mature? So question 44. Face value 100 ACN. I believe in the mistake. There is a mistake in the previous question. Okay. Market price 985 ACN. Annualized interest rate. Annualized interest 4%. 4%. Number of days. Number of days. It is the same as follows. Number of days is equal to how to calculate it. Okay. Face value divided by market price minus 1 over 4% multiplied by 360 days. Number of days we calculated 137 days. Is it clear, Irada? Irada, you are only one, therefore you can also turn on your microphone and say bir daha bura switch elemem hemen. If you are listening to me. Actually. Okay. 45. In a treasury auction of 2.1 billion par value T-bills, following bids were submitted. Bidder amount. So question 45, 44, 45. So bidder let me write it here. Bidder 1, 2, 3, 4, 5. Bid amount 5 million. 700 million. Let me write million. Convert dollar. Okay. Then 1.5 billion. 1.5. Okay. 1 billion. And 600 million. Okay. And bid price. $0.40, 0.9901, 0.9925, 0.9936, and 0.9939. Okay, this is our bidder amount and bid price. Let's rank these bidders with respect to their bid prices. So the highest bid price is from the first bidder. Let me rank like that. This is our first ranker. So the second highest is bidder number 5. And the third highest is bidder number 4. So let's again rewrite the bidder winners in the first place. Bidder 5 or bidder 1 with bid amount of 500 million. Bidder 2, bidder 5. This and 4 a bidder amount of 1 billion. Okay. Sum of them total is 2.5 billion as it's given in the auction. 2.5 billion. So our price, bid price, will be this amount. Because that's the threshold price. That is the lowest price that bid auction closed. So treasury will sell treasury bills to these bidders 1, 5, and 4 at this price, lowest price among them, 0.9936. So auction is sold at this bid price. Therefore, the answer is A. bidders will receive fully at the price of 0.9936. Is it clear, Irada?
Yes, it's clear. Thank you.
Great. Commercial papers issued by corporations are mostly issued by largest, most creditworthy corporations as they are unsecured. That's true. Carry an interest rate that changes according to level of risk. That's also true. Maximum maturity 270 days. It's also true. So 46 is the all of them. Unlike most money market securities, commercial paper is not generally traded in a secondary market. That's correct. Because secondary market for commercial papers doesn't exist. Usually has a term to maturity is longer than a year. It's not correct. The maximum maturity is 270 days for more commercial papers. Is not popular with money market investors because of low default risk. Ne dəxlisi var? Bu onsuz da money market instrumentidir. Tabii ki money market investorlar arasında it will be popular. It will have default risk change on the level of firm's level of risk. So answer is A. Generally is not traded in the secondary market. 48. Assume that bond pays coupon annually selling at par, matures in 5 years and coupon rate of 12%. The yield to maturity on this bond is, if bond selling at par value, it means par bond and coupon rate is equal to yield to maturity. In this case, if our coupon rate is 12%, yield to maturity is also 12%. The answer is B. 49. Assume that there is a 100 ASEAN bond with a 12% coupon rate. Current price of the bond is 180 ASEAN. What is current yield? So price of the bond, 12% coupon rate. Current yield is equal to coupon rate divided by, let me write it here. Face value 100 ASEAN, coupon rate 12%, so it means coupon payment is equal to 100 ASEAN multiplied by 12%. Current price is equal to 980 ASEAN. So current yield, what is current yield? Current yield is firm's dividend annual coupon rate, which is 108.20 divided by current market price. %12.63%. Answer is A. I hope it's clear, Irada. Question?
Yes, it's clear.
Okay, great then. We have left with 10 questions, so be patient. ABC company has a bond with 2 years to maturity, traded with 2% spread over treasury bond. So maturity and yield. 1 year, 2 year, 1, 2, 3. And yield is 5%, 5.5%, 6%, 6.5, and 7%. 5, 5.5, 6, 6.5, and 7%. Okay. What's the present value of this corporate bond? Spread over government bond is 2%. So in this case, our corporate bond yield to maturity will be how many years? As 2 years. So 2 years, we choose 2 years maturity government bond yield. This is our preference. Okay. 5.5 over 2%. So spread over government bond is 2%, therefore corporate bond yield to maturity will be 7.5%. So we have face value 100 ASEAN. We have coupon rate 5%. It means coupon payment is equal to 100 multiplied by 5%, 5 ASEAN. So we have 2 years maturity, 2 years we can easily find present value of bond by using PV formula. We have rate, it is our coupon corporate bond yield to maturity 7.5, number of periods 2 years, payment. Let me see if frequency is paid annually. Okay, that's great. PMT 5 ASEAN, future value, face value, and great. 95.51 ASEAN. Let me change to positive. Our bond price is 95.51 ASEAN. C. Is it clear, Radha?
Yes, it's clear.
Okay. Which of the following is difference between primary and secondary capital markets? So you know that in primary markets, the securities, bonds, and stocks are issued for the first time. Issues of new bonds, new stocks. Therefore, the answer is A. Primary capital markets relate to the sale of new issues, bonds, preferred, and common stocks, while secondary markets are where securities trade after their initial offering. They are initially offered, purchased by initial investors, and then traded in the secondary market. The answer is A. Bonds issued by Asian Development Bank or European Investment Bank, described as, the answer is A, supranational bonds. What supranational bonds means? So region countries, for example, let's take MDB countries, post-Soviet countries. Post-Soviet countries meets and agrees that let's, in order to finance our projects, let's issue supranational bond. And this supranational bond will be traded in all post-Soviet countries, all region countries. For example, okay, let me give you another example. Do you know GUAM countries? Georgia, Ukraine, Azerbaijan, and Moldova. GUAM countries agrees that they will issue bonds in order to finance their projects, common projects. That's a supranational bond. Quasi-government bond are government subdivisions, government agencies. For example, let's take Asan Khidmat. Asan Khidmat issue bonds in order to finance its operations. It is quasi-government bonds because Asan Khidmat is subdivision of government. Non-sovereign government bonds is usually issued by local, let's say, local governments, local states, cities. For example, Texas state in America. Texas state issue bond. It is non-sovereign government bond because it is not issued by national government. It is issued by just one state or one city. For example, Bakı İcra Hakimiyeti. Bakı İcra Hakimiyeti issue bond. It is non-sovereign government bond, not because it is not issued by national government. And sovereign government bond, it is issued by Azerbaijani government, national government. I hope it is also clear. Fixed income security classifications by credit quality most likely include investment grade bonds, actually, because investment grade bonds are safer investments. They have fixed income. They can pay fixed income over the maturity years. They most likely include investment grade bonds. 53. 54. The face value if corporate bond is $100 at issuance and face value is at $155 at 2 years after issuance. Most likely this bond is indexed for inflation. You covered capital index bonds or inflation index bonds or index linked bonds. They are treasury inflation protected securities. They are indexed to inflation. For example, if inflation rate increases or decreases, the principal amount or face value will also increase and decrease accordingly. Not in non-index bonds, the ordinary bonds will have the same face value over the years, despite the fact that inflation rate increases or decreases. But index bond, capital index bonds, they are indexed for inflation, therefore their principal amount, face value, will be adjusted to inflation. So therefore 54 is C. 55, the price and the yield on the bond have an inverse relationship because we are discounting coupon payments and face value by yield in order to find the price. So yield is in the denominator side. So if the denominator increases, the price will decrease, or otherwise denominator decreases, price will increase. Therefore, they have inverse relationship. 56. Assume that corporation issued 2 million bond to finance its new project. The bond pays 8% semi-annual interest and will mature in 10 years. Current interest rate for this bond 6%. What's the price of this bond? Corporation 2 million bond face value. Question 51. Oops, 56. Face value 2 million Pays 8% semi-annual. Annual coupon rate is 8%. So which means semi-annual coupon rate, semi-annual rate will be 8% divided by 2, 0.04. So coupon payment is face value divided multiplied by semi-annual coupon rate. We have maturity years, 10 years, but number of periods, semi-annual, will be 2 times higher than years, 20 periods. Current interest rate, annual interest rate, 6%, but semi-annual rate is equal to 6% divided by 2, which is 3%. So we have number of periods, we have interest rate, we have coupon payment, we have face value. We can easily find present value by using PV formula. Rate, semi-annual rate, number of periods, 20, PMT, 80,000, future value, 2 million. Okay, let me convert to positive sign. So our present value of bond is 2,297,000 and etc. The answer is B. Is it clear, Irada?
Yes, thank you for clarification.
Okay, you're welcome. The current yield on a bond is equal to annual interest rate divided by current market price. The answer is C. Annual coupon interest rate is the coupon rate divided by current market price. Actually, the notation is not also true here. Annual interest rate, no, annual coupon payment should be interest payment, annual interest payment, not rate. Annual interest payment divided by current market price. So, for example, in order to calculate current yield of this bond, I will not divide 80,000 because it is semi-annual. Regardless, the frequency doesn't matter. The frequency is semi-annual, annual. The current yield should be always presented at annual terms. So therefore, current yield face value multiplied by annual coupon rate divided by present value. So this is our current yield. For the simplicity, for the example, that example for question 86. Okay. $58. What is the yield to maturity of bond with face value of 106% coupon rate? Coupon rate is semi-annual, 10 years to maturity, traded on that price. So face value question. Face value 1,000. Annual coupon rate is 6%. So say if paid coupon payment paid semi-annual coupon rate, coupon payment rate will be equal to 6% divided by 2, 3%. So our coupon payment amount will be equal to 1,000 multiplied by semi-annual coupon rate. So 10 years to maturity, 10. But we have periods, semi-annual, again 20. Annual interest rate, semi-annual interest rate, let me copy it down. Annual interest rate. We should find also annual interest rate, by the way. Current price. What's current price? 1,115 dollar sign. Okay, so we can find yield to maturity using rate formula, but yield to maturity in this case will be semi-annual. Rate, number of periods, coupon payment, present value with minus sign, future value is 2.28%, and yield to maturity annum, this multiplied by 2. I hope it's also clear. Here are the question. So what's the answer? 4.56.
It's clear.
And such as B. Oops. So 59. Assume that market interest rate do not change over time. As time passes, the price of zero coupon bond will approach to par value. It is clear because zero coupon bond only pays face value at the maturity. So if time passes, it means the time interval, number of periods is getting decreased. So if it's getting decreased, the current market price will be closer that much to the par value. And at the time in the maturity, at the time of maturity, the current price will be equal to face value, and firm will pay this amount of money to you. So the answer is B. And the last question, in which conditions is bond is selling at discount? Discount bonds coupon rate is less than yield to maturity or market rate. So therefore, the coupon rate is greater than current yield. Note the coupon rate will not same. Coupon rate is less than current yield, which is less than yield to maturity. The answer is C. So if you have any questions.
Kamran, çok sağ ol izahlı başa saldığın için. Her şeyi çok aydın şekilde başa düştüm. Çok sağ olun.
Buyur Değmez.
Bir dənə zəhmət olmasa Excel faylda bölüşərsiniz də axırda.
Exactly, yes. I will share Excel file as well, the recording, but not the questions.
Yes, I know.
Okay. So,
thank you very much for your explanation.
Thank you for you taking your time. Goodbye.
Goodbye, thank you.
See you.